Hello, everyone, and thank you for joining. So today I'm excited to welcome everyone to our roundtable on the next phase of ESG Investing 2.0. My name is Shaheen Contractor. I'm an ESG analyst at Bloomberg Intelligence, which is Bloomberg's research team. And I'm delighted for everyone to join me today. Particularly excited about this conversation. Before we dig in, just to set the scene briefly and outline some discussion topics, which is really around what's next in terms of ESG. Now, so much has happened in terms of ESG over the last year. We've seen renewed policy support in Europe. In the US, we've seen a Biden administration bring climate back into focus. We've seen the emergence of the S in ESG. And I could go on, but I'll stop there. So today I really want to focus on the impacts of all these developments, but more importantly, what our participants think is next in terms of ESG, be it from a product development standpoint or even risks and opportunities that are likely to emerge as a result of all of this. Now, I'd love to keep this conversation organic, so please feel free to jump in, raise your hand, and be as spontaneous as you'd like to be. Now, on that note, just a reminder that today's conversation is on record, and we'll be making the full panel available on demand via the Bloomberg Live YouTube channel after the event concludes. So we'll be able to share this with you, and we encourage you to share it as well. Now, before we begin the program, just a few housekeeping notes. This is a virtual event, so please bear with us if we experience any technical issues. If Zoom crashes or you get disconnected, please close and reopen the application or refresh your browser. Now, if you have any other applications or web pages open, please close them, or if they affect your bandwidth and ability to interact with everyone in the meeting. We also want to keep this discussion conversational, so at any time, if you'd like to chime in, you can use the raise your hand feature. At the top of the Zoom window, you'll see the raise hand icon. And if you want to speak, you can click this button, and I'll do my best to call on you. Also, please introduce yourself, your name, your title, your company before you comment for the first time. And you're also welcome to use the chat box to network, to exchange contact information with any of our participants today. Before we get started, I'd like to introduce Harold. Harold is the head of ESG at Natixis Investment Managers, and he's going to give some opening remarks today. Natixis Investment Managers is sponsoring today's virtual roundtable. Harold, over to you.
Thanks, Shaheen, and yeah, great to be here with this great group of people, and really looking forward to the conversation. I'm going to keep my introductory remarks very short because I really think we have such distinguished and diverse group of voices here that I really would like to get into the conversation as fast as possible. I think the main thing I would like to say is that what I'm seeing in the markets, kind of in the world of ESG, responsible investments today, mainly is a conversation about the objectives of all of this, and I think increasingly, I mean, for me, it's very encouraging to see that increasingly people are, I think, rallying around this view that the point of ESG and sustainable finance is to really see how finance can contribute to solving some of the world's big problems. I think, in our view at Natixis Investment Managers, there's a number of things that asset managers can do to contribute. The most important things are active ownership. Taking our roles as investors seriously, holding management of corporations to account, and supporting them also in their transitions. Another very important tool that we put a lot of emphasis on is blended finance, recognizing that a lot of the activities and solutions that will be required to solve the world's problems need government support or support from development banks, need de-risking for them to become investable at a large scale. Another tool that we think is important is specifically focusing on climate related investment risk is scenario analysis. So I think we'd all agree that it certainly is a good idea to try to measure quantitatively the impacts of climate change on our investments and vice versa. But that increasingly we also need to understand better the qualitative aspects of these risks and these developments. And that's something that we think scenario analysis allows us to do. And finally, recognizing the very important role that governments have in addressing many of the problems that we are talking about under the headers of ESG and SDGs. And obviously climate change is the best example of this. I think, again, we need to recognize that governments have a lot of the tools that need to be deployed to solve problems. And I think investors can play a role in supporting governments develop effective policy solutions. And so I'll stop there. I think those are 4 tools that really there's increasing recognition that they can play a significant role. And that's an area where investors have a responsibility and a possibility, I think, to contribute. And hope we can discuss that, and eager to hear from others here, what their views are on this, and if there are other things that maybe we've overlooked that are also worth exploring.
Wonderful. Thank you so much, Harold. I think your point on investors and the need for tools to support government policy is, I think, particularly interesting, especially since we've seen so much of policy support over the last year. So quite excited to discuss that. But let's dig straight into this conversation. And I'd like to start by asking Kiran the first question. So Kiran, European pensions have always been a first mover when it comes to ESG. What's next for ESG? And I'm particularly curious about the European regulations and also the S as a piece of the puzzle. I'd love your thoughts on that.
Thank you very much, and thank you for the invitation as well, Shaheen. I think it's fair just to mention, given that a lot of the actors or institutional investors in the European Union have been seen as the first movers. But when it comes to Killp, we are Norway's largest pension company, and we are owned by the local government here in Norway. Mm-hmm. And our investments have a long-term perspective where the objective is to derive the best possible return on the pension funds and the saving we invest, and enable to increase the value of the investments over time. We believe that the underlying economic activity must be responsible and sustainable. And we are mostly passively invested in about 10,000 investments in over 70 countries. So it gives us quite, we are quite broadly invested, but it also gives us a quite, a risk all over global. But what helps us the case that, the owners they have quite clear and high expectation in terms of how the pension money is invested. And this explains why we have been working with responsible investments for more than 20 years. And our activities are mainly based on the international norms such as UN Guiding Principle on Business and Human Rights, OECD's Sector Guide for Institutional Investors, and so on. And the reason for why we use that as a framework for our work, because it's gives us a common understanding of the responsibilities of institutional investor, and that we have to make due diligence assessments in a quite demanding and complex financial sector. And we work basically according to 3 methods. The first one is to engage with the company. Even if we are a passive investor, engaging with the company is the most important tool we have, because we as investor, we need to set the expectations, but at the same time it's important for us to understand where the company stands in terms of ESG, what kind of risk they're exposed to, and what's the strategy going forward, given again that we have this long-term perspective. So that's one thing. And the other thing is proxy voting. And the third is that we exclude companies if there is breach with or responsible investments guidelines. But with that, I think I would like to mention that transparency is really important for us. So that's the reason for why we would like to publish the exclusion documents, because in order to set expectations about what is acceptable and non-acceptable for us as investors. And then you said, what is the going forward trends we see as investor, even if this is quite integrated into our work. There I would like to see that, first of all, we see that there is increasingly attention, or both attention and a focus around ESG, both from the government, such as in Norway. It has just only recently passed a Norwegian Transparency Act for mandating human rights and decent work due diligence. And this will impact the companies, because we as investors, we rely on information which is publicly available, and we see that there is a clear difference between the companies which voluntarily report and when there comes a regulation in place, because that gives a quite common understanding for all the companies we are invested in. And that's one thing. And the other thing is that there is increasingly stakeholder engagement, and we also see we have some eco label ESG funds where there is increasing demand, and we see that these are delivering or historically delivering better than the other index funds we have. And the third one is I would like you raised that what's happening within the European Union, and as you probably know, the European Green Deal is a really you could say has helped a lot of the companies, but also investors, in order to understand that ESG is becoming the core. And the European Union just recently launched a draft report on social taxonomy, which is quite exciting, because this is more extended taxonomy to support the economic transition, where we see that the foundation of international norms and principles are giving investors tools to contribute to the finance solutions around ensuring decent work. And since we are in the pandemic, for us, what we see that the pandemic has amplified a lot of the social inequalities, such as labor rights are threatened and so on. So you can say that there is happening a lot over a lot of different along both on the regulation side, but also what the clients and the customers require. And the third is that we see that the financial industry has a major role to play.
Yep, that's definitely true. And those are all good points, especially the social taxonomies. I think that's particularly important. Maybe I'll go to Laurent. Laurent, again, the same question for European pension funds. Being a first mover, I think the policy support, the regulations outlined by Kiran are particularly relevant. I'd ask you sort of what's next for ESG, and mainly what do you expect in a post-COVID world? What do you see changing, or what do you see not changing?
Hello, everybody. As KLP, I think ERAFP was a part of the first movers for ESG right after its creation in 2005. We have the SRI Charter created in 2006, and our policy for the moment, I think I can say, is ancient and authentic. It covers all asset classes. It is based on a best-in-class approach, and we have a strong engagement policy. But what are the new challenges and changes, as you asked, for us? We have three priorities for the moment. The first one is energy transition, and I'll come back in more details on this. The second one is the financing of SME and mid-caps to support employment, tech innovation. And this is, of course, very important in the present economic circumstances. And the third one is more specific to us, but is related to financing affordable housing for our beneficiaries. Mm. So concerning energy transition, the subject, of course, was part for years now of our ESG policy, but this is the biggest priority now, and it's a complex challenge. And beyond what we did over the past years, we have decided to commit with a number of other investors to have a carbon neutral portfolio by 2050. And to manage that, this is a gradual but very deep change, of course. We are part of the Net Zero Asset Owner Alliance, and within the alliance, we have put together a common methodology to set our targets for successive periods of 5 years concerning targets and action plans. So we are now in the process of setting our action plans and targets for the period 2020-2025. So this was the key change in our approach. We have been working for a year with the teams internally, with our asset managers, to prepare our decision. And now this is under discussion with the board of directors, and we hope a decision by next October. And this decision should cover three aspects. The first one is the size of the reduction of our the carbon intensity of our portfolio between 2020 and 2025. The second is the increase of our engagement effort with companies. This engagement effort specifically on energy transition already exists, but we want to boost it, let's say. And thirdly, we will define the size of our financing effort of energy transition over the next few years. All that taking into account the fact that it mustn't be detrimental to our fiduciary duty. So this is the main new project going on for us.
No, thank you, Laurent. That's very interesting. And I know, Andreas, you had your hand raised, and I think you have a lot to say on the sustainable finance policy in Europe. So maybe, do you want to chime in briefly?
Yeah, maybe briefly. So I think social taxonomy is indeed very important. Having discussed it just earlier this morning, you could imagine, for instance, over time, preferential cost of debt for activities like education or elderly care, or some better fair trade standard in a certain activity. It will likely work very much like the environmental taxonomy. You have an activity and they have a substantial contribution threshold to make a lasting social contribution, and you have social, if you want to, minimum standards. And these could, for instance, be diversity. So diversity standards could be a social minimum. It will focus somewhat more on operational expenditures, or operating expenditures to be precise, than on capital expenditures, because social is more operating expenditure. So that is, I think, an attractive thing, and we're seeing the first discussions about it. And then net zero is certainly hugely important. We have the Paris-aligned benchmarks who have been invested by up to 50 billion by now in targeting net zero. So just briefly.
No, wonderful. I think those are all very relevant points, if I may say, of what's changed over the last year. Because I think maybe up to a year back, we've not been hearing these things, at least not to this extent. So quite exciting. Maybe Professor Alex, we'd come to you next. And you've been in academia for years and sort of following the same theme of what's next for ESG. How have businesses changed in recent years, or how have businesses adapted or not adapted? We'll get some just brief comments there and just keep it more conversational.
Great. Well, thanks very much for the invitation. It's great to be here. So I think there's been two trends I'd like to highlight. So the first, a positive one, and the second, a more negative one. So I think the positive trend is just how important and mainstream ESG has become. So maybe 15 years ago when I started my career in this, it was known as CSR. And that was something that you could silo and pigeonhole in a CSR department. Now, it is in many organizations a CEO level issue. And in part, that's due to a lot of research showing there is a business case for ESG. So it's not only good for society, it's not only ethically good, but it's important for the long-term success and sustainability of a business. So this is something which is becoming mainstream. And what's really interesting about having Andreas and me is we are both finance professors. While we're not ethics professors or philosophy professors, we're showing that this is something which is important for the firm's long-term financial success. But then when I go to the more negative trend, it has become a little bit rather unfocused. And so there's now some companies thinking, well, to do ESG, I need to tick every single box. I need to address all 17 of the SDGs. And that is in part due to some less rigorous research, which tends to claim ESG always pays off. So if you write a study which claims ESG is always beneficial, then people will latch onto it and like it and share it and retweet it, even if it's not rigorous, because it's what people would like to believe. And so based and in part on some of that work, companies think, well, let me just try and speak out or invest or say something about every single issue. When in fact, the more rigorous research shows that only if ESG focuses on the more material issues that the company is uniquely placed to address, then does it lead to long-term sustainable returns. So what do we mean then by good ESG? Well, a company can think about what are the major social problems that we have in the world, but what are the ones that we are uniquely placed to solve? And let me just end my comments with one practical example. So one example I think was great was when Vodafone launched M-Pesa, which is a mobile money service in Kenya, and it provided financial inclusion to hundreds of thousands of people. So why did it choose to focus on that? Not climate change or diversity inclusion, even though those are really important issues, because with its technology, it was able to have a unique position in order to launch this mobile money service. And so it chose to focus on that. So what I'd like in terms of going forwards, which was part of some of the other panelists' remarks, is to understand that actually to be an ESG company, you don't need to take every single box, but to understand what are the most material issues for you and which are the ones that you have unique comparative advantage in addressing.
No, that's a great point. And I think to your point, when you're sort of checking the box, you dilute your message a little. And I think that brings to light a lot of the greenwashing concerns, which is what I've been hearing increased sort of comments on. Sam, I saw you nodding your head. I'd love to get your thoughts, if any, on sort of if you've been saying sort of greenwashing concerns, or I know you're very involved in engagement, so I'd love to see any thoughts there, and feel free to keep it brief.
Yeah, thank you. In terms of just a brief introduction, my name's Samantha Hill. I'm a managing director in our sustainable investing group at CPP Investments, and I'll get to your point in just a second there, Shaheen, but we aspire to be the capital provider of choice for ESG astute companies. So this really means something in respect of our investment decision-making and asset management activities. And we think about it too as a differentiator in our value proposition and what we bring to the table as a partner and a capital provider. And this is absolutely the mentality that we bring to our engagements with our current or prospective portfolio companies. And we know that the nature of business risk has really changed, and echoing Alex and others, that ESG has now really moved to being within those business critical elements to understand and to get right. These are 21st century business risks and opportunities. And so we and other institutional investors have seen the value in engagement for a long time. I've personally been at it for close to 15 years now. And while I think there's probably been a change in volume and perhaps the number of investors now engaging with their portfolio companies on ESG, including climate-related topics, it's also about the increased value add that the companies are deriving from these interactions, which is driving demand and also how proactively these conversations are happening. Market participants and the financial ecosystem have shifted in the collective mentality on ESG and climate, with a growing realization that these matters present business critical risks and opportunities. And maybe just to step back for a second and contextualize this against what we what we saw maybe historically when there were kind of these major pivot points or major events that have happened. Many of us who've been at this for some time experienced what it was crisis. We saw what this did to the trajectory of ESG, including climate-related conversations, and it really did stall it in many respects. And topics almost completely came off the corporate agendas, or certainly moved down the priority list. But as the world climbed out of that, ESG and climate came back slowly but steadily, I'd say, for a period of time. And then, of course, the uptick in activity over awareness and appreciation of the complexity that is climate change certainly has been extraordinary in the recent past to what it once was. It probably wasn't that long ago that at least some of my fellow panelists here were still having conversations about climate change being real. So it was a question mark when the pandemic hit. Was this going to be a repeat like post GFC, or would it be a critical pivotal moment? And so we didn't really have to wait too long. I do think to find that out, and back at the top of the agenda, the Build Back Better mantra being repeated globally, of course, but really you'd be hard pressed today to find a board or management team that doesn't list ESG and climate among the most pressing business issues that their companies face.
That's
and our expectation is that boards provide oversight and counsel to ensure their companies integrate the considerations of all material business risks. I know Alex just made that really critical point, and it can't be emphasized enough, including those that are ESG related, that tie into strategy, that tie into operations, that tie into their disclosure and reporting. And companies have to determine what these are and not treat it like a check the box exercise, and really think about it from that strategic perspective. So I think that's where the risk still remains a bit in respect of what you see as it relates to greenwashing and commitments or statements that companies make. But increasingly, the investor base and the marketplace is sophisticated in its expectations around the type of information that's being provided and the depth and how pervasive it is alongside the other, strategic, financial, operational considerations that companies have and the decisions that they're making.
That makes sense. And Sam, I think you raised a really good point on climate change. So maybe that's a great point for Fabrizio to chime in. Fabrizio, you've been I think you know a lot more about sort of the policy angle, the sustainable finance taxonomies, even moving beyond that. And I'm particularly curious as to your thoughts on new products, and then also on the risk asset manager space. I hear both excitement and nerves when I talk to asset managers and European policy. So would love to get your thoughts.
More than happy. And good afternoon, ladies and gentlemen, and thanks for having me. I am Fabrizio Zumbo. I'm an associate director at Cerulli Associate in London. I lead the European Asset and Wealth Management research practice in London. We perform market and competitive intelligence in the UK, continental Europe, in the Nordics, and we analyze asset management product development trends, investment, operational, and marketing strategies, and so far and so forth. So to answer your question, I think we should start with something very important here, is the assets of ESG mutual funds and ETF in Europe, which experienced an spectacular growth last year, and the trend is continuing. So if you look at the the data at the end of last year, 2020, we had 1.3 trillion of ESG mutual fund assets, and ESG ETFs asset reached 83.3 billion, boosted by net sales of 43.3 billion over the year. And by the end of 2020, the Europe domiciled ESG mutual funds and ETF assets accounted for something like 12% of the overall assets in Europe, and it was just 66% in 2020. And just to give a key figure here, ESG products last year attracted 251 billion of net new assets, net new flows from investors, and managers have been really unveiling a number of specialist value propositions. So the value proposition is growing, but as well the value proposition is specializing. In 2020, managers launched 568 new ESG mutual funds and 93 ESG ETFs. By May this year, we have 256 new ESG mutual funds and 42 new ESG ETF. Of course, this has been this spectacular growth have been accompanied by drastic shift towards sustainability, not just in the investor community, but also in the society overall. I'm talking about Europe, but Europe and beyond, particularly post-COVID pandemic. But as well, as you were mentioning, a series of new regulation as part of the EU Green Action Plan. SFDR, taxonomy regulations. I think something very important will be the draft legislation for updates to the MiFID II, which will be a big factor in driving retail client flows. And actually, in this context, distributor will have to ask about their ESG preferences for October 2020. So the other panelists we're talking about is the distributional channels, and really they're the driver that they're shaping the agenda. But what we see as well is the wealth management segment, which is growing and embracing the ESG domain. It's of course like large banking groups, private banking groups are the domain that have been jumping on the train, but there's no doubt that ESG is a top priority for European asset managers.
Definitely, and Fabrice, just to jump in there. So I think we've heard a lot about ESG growing, and I really like your points on the growth in Europe. I think that's particularly interesting in setting the scene. Maybe I'd love to at this point as a segue bring in Harold. Harold, we've heard about ESG and some of the opportunities there and sort of the size of the market. I'm curious as to sort of the sister of ESG, impact investing. What do you see as some trends there and some of the growth there? Maybe just some quick and brief comments there, because I'd love to get Kate in on this as well.
Sure. No, I think that is a very exciting area also for us, but as a company, but also for the larger market. I think, as I said in my introductory comments, I think there's an increasing sort of consensus that the point of ESG and sustainable finance is not only to find ways to generate outperformance through ESG, even though that's obviously important, and what Alex also referred to is a question of identifying materiality, and that's obviously also as part of the bigger equation, investors interacting with the companies that they invest in and so forth. That is obviously a key part of what we're doing. But at the same time, I think increasingly people are also saying, well, yes, financial performance is really nice, but wasn't the idea also to contribute to solving the world's problems and making the world a better place? And I think that's where the increasing focus on impact investing is coming from. At the same time, I think there's also there's many academics, especially doing research on what kinds of impact investments we're seeing, and making a distinction, I think, between kind of impact alignment, it's basically called, and impact facilitating or impact enabling. And so more and more people, I think, are really interested in the latter, basically finding ways that investing or putting capital into companies or projects really enables things to happen that otherwise wouldn't happen. I think, as I said earlier, blended finance is a really good example of that, because you're basically finding activities, companies that are not investable, at least not investable for institutional investors today, because they don't meet the risk return or scale requirements, and then finding ways, for example, working with governments or development banks to de-risk those, or for governments to co-invest, that changes the risk return profile of these investments, and that makes those projects investable, at least at larger scale. And so that's blended finance. I think it's a great area to work on. It's something that actually a lot of people in our company are increasingly interested in, also because they see that there's really a need for investment expertise to be brought to the table, and also people working with governments, with development banks, with NGOs to really put these deals together. So that I think is a very exciting area.
Yeah. And those are great points, Harold, on sort of like what you mentioned on solving world problems. And Kate, I would love to get your thoughts on mission investments and foundations really putting their money where their mouth is. I think they're sort of they claim to be at the sort of head front of solving the world's problems. So what trends are you seeing there? And
Absolutely.
would love some just brief comments.
Great, and thanks for inviting me into the conversation. And I, would echo so many of the comments thus far, particularly, Kiran's thought that COVID really amplified a lot of the trends that we had seen in place. And I think that's been, exciting in a lot of ways. It also helps us recognize that we have some major global challenges ahead. And so these conversations are increasingly important. In terms of some of those trends that were in place, the mainstreaming that everyone has mentioned has been critical. And so as we think about the not-for-profits that we work with as a consulting firm, effectively, every single one of these organizations is coming to us with mission and some core values. And so it's been only natural that conversation turns to the largest asset of that kind of endowment portfolio. How do we use that? How do we move beyond grant making to make a big difference? I think we've had tremendous leadership, here represented by the European pensions, in the US, some of the largest asset owners who have been really transparent and collaborative and kind of bringing along smaller participants. I think that's been tremendous. Just the conversation at how challenging it can be to truly implement, and, being willing to kind of share their pathways, and the concept that this is iterative. I think that innovation, particularly that Fabrizio and Harold just spoke of, where we are seeing, that increased demand lead to all sorts of new products, whether it's something where it's scale and you all of a sudden have funds that are using engagement across a number of different asset owners, really bringing groups together. Or something very niche. So on the impact side of things, digital equity or community development, and really being able to kind of find interesting solutions, I think, that weren't there previously. Obviously, regulation and standard setting is, one of the big challenges, I think, at this point. And we're seeing increased collaboration, but on our end, I think the reporting and being able to move beyond, the performance or portfolio holdings, and really being able to demonstrate impact is going to be the next big challenge.
That's definitely true. And Laurent, I want to come to you, because you talked about affordable housing and small, medium enterprises. And we've heard a lot today about sort of de-risking investments. We've heard a lot about the challenges to implementing this. Any thoughts there? And we'll keep it brief, because I see Harold also nodding a lot. So we'll come to Harold next. Laurent, any thoughts there? And if you're on, Laurent, you might be on mute.
Oh, sorry. What was your questions?
No, of course. So, Sam, I think Andreas and Kate, we were talking a lot about sort of within impact investing, de-risking investments, and the sort of the challenges over there. And you mentioned SMEs, you mentioned affordable housing a lot. So I was curious as to your thoughts there, and I mentioned that Harold's nodding his head, so we'd keep it brief and then get Harold's thoughts there.
So we invest in these two fields that you mentioned, but without looking for de-risking or co-financing with public authorities. So we look at opportunities that stand by themselves with their own business plan and their own profit. So that's the key approach that we have in concerning real estate. We invest around 800 million euros annually, new money, about 50% of that being dedicated to housing and mostly affordable housing. But it's normal real estate investing in the framework of the fiscal and other characteristics of this kind of investment. And same concerning tech, small and mid caps. It's whether listed or private equity, but in all cases based on financial consideration as being the fundamental criteria for putting money in it.
That makes sense. Kiran, I see you raising your hand, but I just want some quick comments for Harold before getting to your comments.
Well, I certainly don't want to hog the conversation, but I think so. It is a very interesting area. I think what Laurent is saying, I certainly recognize. There's also a lot of that type of investing going on in our company, trying to find companies that are doing meaningful things for society. I think the big question is going to be, for example, looking at the European Green Deal. So obviously there was just today there was a big, it was already announced last year, but today there was a big announcement about some of the details of it. I think what is always interesting with these big announcements is, first of all, this is great news to see that there is this movement, and if these plans are actually implemented, I think that's going to be a huge step. And I think really great to see European leadership, and hope that the US and China and other countries will follow suit. But I think there's still, even though it's good news, there's still a lot of questions. One big question for me, and where investors can really play a role, is the question of where is all the capital going to come from? Sure. And I think the Green Deal is something like $1 trillion that is required, and I think what I've seen is that about half of that is supposed to come from mobilizing private capital. And so I think that sounds great on paper. However, I immediately start thinking, is like, okay, how does that work in practice? Because it does mean that governments have to think very proactively about what kind of programs are we going to put in place? How are we going to make those programs and those activities attractive for institutional investors that have that kind of money? And that really is going to require, I think, very intensive collaboration, bringing people to the table, structuring projects, structuring deals, working out the financial aspects. And that, I think, is really an area where institutional investors, or just investors generally, can make a huge contribution. But they have to be proactive, I think, and commit, to sitting at the table and making their resources available for this.
True. And maybe to that point on institutional investors, Kiran, I see you have your hand raised. But then yes. I do quickly want to come to Andreas and ask a more pertinent question on my mind.
Yes, just very briefly, I have to say that even if, we very often see this from the European Union perspective, but we need to remember that, there are still companies where we engage with the companies, and they say, you are the first investor who would just like to discuss ESG and not the financial returns. So we need to remember that, the reality might be quite different in the different locations. That's one thing. And the other thing is there's one other topic which we have followed quite and quite concerned about is deforestation in Amazon. And we see that, we as investors and, we have collaboration with other investors, and we are trying to use the tools we have available in order to see how the companies can mitigate that risk. But at the same time, we see that the Brazilian currently government is putting a lot of incentives and regulation in place, which gives incentives for deforestation. And, that is quite difficult to see.
True,
so we are pretty much dependent on the governments in this area as well.
Okay. And speaking of governments, Andreas, I know you have your hand raised, so I'd love comments there, but I'm particularly interested about your comments on just new products and new opportunities as a result of all this. Harold made some great comments on sort of where is the capital going to come from, but my question is, where is the capital going to go?
So in terms of products, the most successful products out of the European Technical Expert Group have so far been the Paris Line benchmarks and the climate transition benchmarks. AP2, the Swedish National Pension Fund, has put the entire liquid portfolio in a Paris Line benchmark that was in-house constructed. And you have another several billion, about over 10 from other asset managers coming out. So that's a product where you have a declining balance, 7% reductions in greenhouse gas emissions year on year. And that kind of addresses the question where the money goes to and where it's coming from. So the money is coming from investments, in particular, direct primary market fixed income investments in fossil fuel firms, because if we don't de-brown the economy, we're actually never going to make the Paris Agreement. And it's moving to those companies that are successfully transitioning from a climate perspective. They may be in heavy sectors, they may be in light sectors, but it's certainly moving to those that help to actually transition. If I have a minute to speak on greenwashing, I do think it's important to highlight that it happens everywhere. So clearly what happens in Brazil with the Amazon and the reports that came out that potentially the Amazon may already be collapsing is absolutely tragic. But much closer to home, the prime ministers of Finland and Sweden wrote a letter in April to the president of the European Commission requesting, and let me state this, they requested for close to nature forestry to be removed from the do no significant harm criteria of the taxonomy. So that for countries that are known to be particularly sustainable is not particularly green. I should flag that the environment ministers in both cases disagree, but we have greenwashing everywhere and much closer to home than Brazil.
Very much so. And I have one question for Alex that I think is particularly interesting. Alex, being in academia, I'm curious as to what you think about sort of when we talk about the next phase of ESG, what do you think about artificial intelligence, big data? I've been hearing a lot about it, but maybe seen some action picking up over the last maybe year or so. And if you have any pertinent examples to share, I think we'd love that.
Certainly. So certainly data is going to be useful. And as an academic, I should embrace the use of data, right? One of the roles in it is to try and make something which is historically rather abstract, somewhat concrete. But I think if we are to use data, we should also recognize the limitations. So unfortunately, there does seem to be this view that data is a panacea. When we're able to measure ESG, then everything is going to completely change. But I don't think ESG is something that you can measure. It's something that you can assess. And assessment does involve data, but it also involves some qualitative aspects, right? So as putting on my practitioner hat, the head of sustainable investing for Royal London, where I'm on this investment committee, says that you can't make something artisan computational, right? To try to assess which companies are really, truly good in ESG rather than greenwashing, that involves a qualitative assessment of materiality, comparative advantage, management competence. And these are things for which boots on the ground investing, meeting management and understanding the business context is going to be useful. So certainly we do want to have some data. And if there is artificial intelligence and other new ways to get data, I think that's beneficial. But there's so many aspects of ESG which are difficult to quantify. Yes, we can measure things like employee turnover, wages, we can look at injury rates, absenteeism, presenteeism, but can we measure meaningful work and skills development, a corporate culture which encourages and tolerates dissent, and the opportunities to step up as a junior employee? Not necessarily. So while we do want data, I think we should also recognize the limitations of data and also try to supplement that with some qualitative assessments.
That's great. And Sam, I'd love for you to maybe chime in there on measuring ESG and sort of the quantitative versus the qualitative aspect and anything you're seeing there.
Yeah, absolutely. And I mean, couldn't agree with Alex more in respect of what he's framed there in his comments. I mean, we do want to see, evidence that companies are actually achieving the things that they say that they're setting out to achieve as it relates to, actual performance metrics and KPIs versus, only making statements or commitments or having policies. Those are important things, but the performance also matters. And so where we can achieve getting access to that data and encouraging companies to provide us with that data, and to the point that's been made several times over, it's material to their business. Absolutely, we want to see that, and we want to see it come through, and it can come through in many respects. But on the other side of things, so much of what is about ESG and what can be achieved and how it translates to being a good business that remains a going concern, that's competitive, is and will endure the unknown unknowns that I think having a good handle on ESG really will help companies position themselves for what the unknown future can hold. But that really is a much more qualitative conversation. It's about having relationships with management teams. And so maybe there's an issue there just in respect of the scale that can be achieved and how many companies you can have true insights as to how that's going. But those dedicated efforts absolutely do matter. And it's not just the data in isolation, it's the combination of all those things.
Right. Yeah, no, definitely. Fabrizio, maybe a question for you, and this is just sort of being in research. I would love to get your thoughts on sort of what are some ESG data sets that you hope to see, but you're not seeing yet, and maybe just some quick comments there.
That's a very good question, and I have to be honest, I agree with the comments made by Samantha and Alex. I mean, no data, no party, but it's not just a quantitative type of data. And what I want to, the point I wanted to make here is that in the product development, the current ESG markets is slightly heavily dependent on ESG rating providers to assess and communicate performance on sustainabilities. These ratings are useful barometer for investors, but there's a kind of lack of alternative, and this could be a little bit problematic. Something that is could be problematic as well is the inconsistencies among ESG data providers. This could be because there is a lack of common standards for company reporting, and there's different regulations in different countries, particularly in Europe, that are asking companies to report on this data. Something problematic is that there's a low correlation between ESG rating across providers, and actually this is because ESG is not just data, but is based on values, and these values are evolving, and for you means something, and for me it could mean something different. And if you look at the credit rating agency, they have a clear objective, is assessing the credit worthiness of a company, right? And the credit worthiness of a company, the end game is the bankruptcy, right? There's not something similar for
and Fabrizio, just to pick up on something you said there, which is the lack of common standards. So I hear what you're saying. You're saying there's a lack of common standards in the world of ESG. I want to get Kate's thoughts on this when it comes to foundations, more impact, more mission-aligned investments. What about the standards there? And I'd love for it to be kept brief because I do want to go 30 seconds around the room before we conclude and just keeping it in time.
Absolutely. And I think, pointing to that as one of the challenges, as we think about portfolios and implementation, we're working with, in some cases, incomplete data. And I agree, it really requires us as a firm to dig in, know the investment managers, know their processes, try and understand individual decisions in order to really deliver on the impact and kind of promise of ESG. I think the other comments around the fact that, part of this is materiality. The other piece is the lens with which you're looking at things, and what you're going to, as an organization, frame as important is an additional wrinkle in trying to get to the right solution.
That's wonderful. And I think we have just a few minutes left. So I'd love to get concluding remarks for everybody, maybe just 30 seconds. What is top of mind? Let's do a fire drill. So maybe let's start with Kiran.
I think the only thing I would like to say here is that this is a conversation that we'd like to continue, because there are massive challenges, and this is something you don't have. This is something we require that more actors work on that. So I think that would be my brief comment here.
Wonderful. And Alex, coming to you, 30 seconds. What is top of mind? What is one thing that's next for ESG, or what is one thing you want to see?
I think the importance of rigor and evidence is really key, right? There's tons and tons of ESG metrics, loads of studies saying, oh, this pays off and that pays off and so on. But we need to see, well, are these things actually really carefully measured? Is this correlation or is this causation? So that is the role of academic research, right? This is a very practical and real issue, but the role of research is to try to make sure that any ESG practices that we are going to implement are based on rigorous data rather than wishful thinking.
Very true, and I think it's the evidence that would maybe contribute to less greenwashing risks and companies to stop checking all boxes, which is what I think is contributing that to a great extent. No, great comments there. Laurent, I'd come to you. What are your concluding remarks? What is the one thing you want to see as ESG 2.0? Laurent, if you're on mute.
Yes, I was saying that some things that I find extremely encouraging is the fact that recently the engagement that we have with some big companies shows that at CEO and chairman level, they take more and more seriously the dialogue with investors. And we have very constructive and very substantial discussion on the announcements concerning the energy transition policy. And this is a very important matter, because it's there that we can get real impacts through the companies in which we invest.
Very nice. Very, very, very true. Sam, over to you. What are your concluding remarks?
I think, as many have pointed out, the helping companies to navigate how to consider the plethora of standards and frameworks that are out there, and how that all ties back to what is then material for their businesses from a strategic, from a financial, from an operational perspective. That needs to stay at the top of agenda for investors, and companies need to continue to be open that, including as we go into a period of time where there is going to be a lot of conversation around what is the right way for all of these different standards and frameworks to converge and merge and really keep us moving in that direction.
Very true. And I think converging materiality in those frameworks, at least in my opinion, is sort of the next avenue, or at least I hope it is. Next, Harold, what are some thoughts there? What do you hope, ESG evolves to?
Well, I think two things. And first, just to echo what Alex already said, I do think it's very important that we are, as much as possible, fact-based, research-based, evidence-based. We want to, I think, focus on practices that we actually know are working or are likely to work. But so Alex already explained that very well. So the other thing is going back also to what Fabrizio and Kate were saying earlier about data and measuring things. So I think that's actually a really important point. And we actually published a paper about this. It's called Labeling versus Enabling, where we talk about the importance of being clear on what you're trying to enable in order to determine what the things are you want to label or measure. So measurement, quantifying things is incredibly important and incredibly useful as long as you first know what you're actually setting out to do. And so I really hope for the entire ESG community that we can embrace this kind of mindset going forward.
True. Fabrizio, you're next. Maybe just some quick comments.
Thanks.
I think
very quick. I mean, I echoed all the panelists. Very interesting point. I would stress the point of education and increasing awareness are set to be key components for the future growth of Europe in Europe and beyond, together with standardization. And especially if you want to target retail clients, I think is key.
Very good. Kate, what about you?
Yeah, just the collaboration, and here having so many representatives from large asset owners, asset managers, policy is important. So bringing businesses, corporations together, I think, in order to solve these grand problems.
True. No, very, very true. And unfortunately, we're out of time, and I think we'd have to just leave it there. But I want to thank everyone for making the time to participate in today's events and for everyone's insightful contributions. I think Fabrizio mentioned awareness, mentioned education. I, for one, have found this very educational. So I'd like to thank everyone again and encourage everyone to continue the dialogue and all the great work and contribution people are making. With that, I'll leave it there. Thank you to everybody.
Thank you very much.
Thank you
Have
very
a
much.
good evening.
Thank you, Shaheen.
Bye.
Bye.